Webjet reported a 24% drop in EBITDA, and its shares fell 15% to a record low on the same day Virgin Australia announced it would substantially cut commission payments to Webjet Marketing effective July 2026. The coincidence of timing matters because each event alone would reprice Webjet as a cyclical casualty, but together they raise a different question, whether the thesis that Webjet recovers when travel demand recovers is still the right frame at all. The prior thesis on Webjet was straightforward. Geopolitical disruption suppresses booking volumes, costs rise, earnings fall, but once the Hormuz blockade eases and fuel normalizes, the OTA rebounds with demand. That is the thesis every analyst holding a buy rating is implicitly running. The Virgin commission cut does not fit that story because it is not a cyclical event, it is a structural one, and it arrived while earnings were already under pressure from the macro. What makes the Virgin announcement the more dangerous signal is not the immediate revenue impact. Webjet estimated the cut would have reduced FY26 revenue by approximately $3 million Australian dollars had it applied for the full year. That number on its own is not thesis-breaking. What it signals is that Virgin moved against Webjet at the exact moment Webjet had no leverage to push back, when its own earnings were already compressed, when the Middle East conflict was suppressing the bookings that generate Webjet's negotiating volume. Airlines grant better commission terms to distributors who deliver high booking volumes. When volumes collapse, so does the distributor's bargaining position. The participant timing structure here is worth examining directly. The sell-side community holding buy ratings on Webjet had not yet moved by the time shares opened on May 20. The 15% crash was the market absorbing both the earnings miss and the Virgin news simultaneously, not a gradual institutional repositioning. The absence of pre-announcement broker downgrades suggests the commission restructure was not telegraphed to the institutional community in advance. That means the repricing was retail and fast money led on the day, while institutional holders were still holding positions priced against the old recovery thesis. The question that repricing leaves open is whether the institutional community has since confirmed the thesis break, or whether they are waiting to see whether the Hormuz situation resolves before deciding if the Virgin cut is permanent architecture or temporary opportunism by an airline that had unusual leverage during a travel demand shock.
The structural dimension that changes the Webjet picture is not the dollar value of the commission cut. It is what the cut reveals about Virgin Australia's distribution strategy in a post-IPO operating environment. Virgin launched on the ASX in late June last year and is now running a direct distribution build that includes its own digital channels, its Velocity loyalty program, and an expanding holiday packages business. Airlines globally have been pursuing this model for over a decade, but the Australian domestic market had preserved OTA commission economics longer than most because of the duopoly structure between Qantas and Virgin. The moment Virgin has enough direct booking volume to reduce its dependence on Webjet, the structural incentive to pay full commissions disappears, and that moment appears to have arrived. The counter-signal worth holding is that Webjet's commission exposure to Virgin is not symmetric with its total earnings base. The $3 million revenue estimate for the Virgin commission cut is a fraction of Webjet's overall OTA revenue. Webjet Marketing distributes for multiple airlines, and the WebBets business, which reported a 20%. The recovery thesis for Webjet runs through the Hormuz Strait, and the timing here is genuinely complex. Brent crude fell more than 5% on hopes of a U.S.-Iran Memorandum of Understanding, with WTI touching $91 per barrel, down from above $110 earlier in May. Flight Centre lost $10 million in April profits alone from cancellations and refunds driven by Middle East tensions, and warned that May and June would likely be worse. That demand shock sits on Webjet's booking volumes in the same period. The resolution path has a structural lag that the market is not fully pricing. Sparta, a Singapore-based shipping data firm, estimates 3 to 6 months to restore global oil supply to pre-war levels even after a deal is signed. Time for production to restart, refineries to normalize, and stranded shipping inventory to clear. Capital economics puts meaningful supply-demand balance improvement beyond 2027. That means even a signed Hormuz deal does not immediately restore the booking environment that Webjet needs to rebuild negotiating leverage with airlines. Here is the reversal most participants are missing. The Hormuz easing is actually more valuable for Qantas and Virgin Australia than it is for Webjet, for a reason that is structurally asymmetric. When fuel costs normalize and travel demand recovers, airlines will have less urgency to push through commission restructures, but they will also have less urgency to reverse the ones already implemented. Virgin's 1 July commission cut does not come with a reversal clause tied to oil prices. If the demand environment improves, Virgin gets both better revenue per passenger through direct channels and a lower commission line. The OTA distribution cut becomes permanently locked in as a margin enhancement rather than a crisis measure. The monitoring variable for the Webjet thesis is therefore not when the Hormuz deal gets signed. It is whether in the first full reporting period after 1 July 2026, any second airline partner moves against Webjet's commission structure under conditions where Webjet's volume has already partially recovered from the geopolitical shock. A recovery in airline traffic that fails to reverse the commission restructure trajectory is the condition under which the old Webjet thesis, OTA leverage grows with booking volume, no longer functions as expected. Analyst consensus is priced against recovery restoring Webjet's position. The 1 July date is where that assumption gets its first real test. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.